Hey guys, we're all looking for a piece of that American dream, which is owning your own home. So, the day you decide you want to buy a home or you want to upgrade from the one you're currently living in, you go find a real estate agent and start hunting for homes. And that agent finds you your dream home, and now the next big step is finding the money to buy that home. And that's where today's guest, Rhea Rai, comes in. She's been working in the mortgage origination business for over 22 years. Currently, she's the VP of Ameris Bank in Fairfax. I have worked extensively with her, and I've realized she's always delivered on her promises. So I have the pleasure to have her here on our show today, and we're going to be talking about everything about mortgage and loans with her today. Welcome, Rhea.
Thanks for having me here. It's really exciting to come and sit and talk and share the knowledge that I have had over 2 decades. I've been through different markets and I've seen this industry change a lot, just the trends, the rates, the whole guidelines part of things with the loans and products. So I'm happy to share any knowledge that can help people, make a firm decision on their home buying process.
Thank you, and that's why we have you here. Now, I know I did say that once you find a home, the next big step is looking for a loan, but I think maybe we need to take a pause here and think, is that really the first step, or the first step should be actually trying to find out how much of a home can you afford? Should people come to you before they start looking for a home to kind of give them an idea of, what all can they buy within their budget? What do you think?
Yes, absolutely. I think a lot of this happens when people do the last minute process where they've gone out with the realtor and looked at multiple homes, and then last minute when they want to place an offer 24 hours prior, they're trying to look for a lender. And that's just putting yourself, the buyers, the seller, everybody at risk, right? Because now at last minute, we don't even know what's going on with their financing and profile. So the right way to do it is to always start early. Typically talk to your realtor about the areas you want to look at. And at the same time, you want to nail down your lender and talk to them what products will be good for you, what you can be allowed in your income limits and your ratios and all of that stuff. And that way they can do a full pre-approval application, which is a soft credit check. And usually when you're pre-approved, you're good for 4 months. So the lender will give you a timeline that, hey, now you're good for 4 months or up to 6 months. And so that way you're comfortable going out there and looking at homes, and your budget, you're qualified up to this much amount, and you're not going to go beyond that.
Now, interestingly, you said it's going to be a soft pull, and I have a lot of clients who come to me. Of course, they're not interested in having an inquiry on their credit yet. They come to me and say, "Oh, we pulled our report on Credit Karma, and then this is our score." Is that a valid score for a loan purposes? Can you go by those numbers, or should they still give you all the details, their income, their debts and all that, for you to get a better picture of their loan?
Yeah, no. So the thing is with scores is the scoring models are very different for different industries. So Credit Karma is just an overall picture of maybe what your credit would be. Similarly, if you go apply for a car loan, the car companies have a different scoring model.
Right.
For mortgage industry, it's very conservative. It's tougher, it's more stricter, there's more parameters used by these credit bureaus. So generally, your scores are going to be very different. A lot of times, we've seen the scores very different from what people say they have on Credit Karma. So that's not even a valid scoring model that we all use. So you always want to get your pre-approval, and like I said, we do a soft check. I'm not sure about other lenders, but we'll do a soft check so it won't hurt your credit. And at the same time, we get your scores and we know what to work with. Also keep in mind a client's mortgage rate is dependent on their score. So if we are going based off of a Credit Karma score, we're not even getting a good idea on the rates that they're going to get. So it's just all very illusional at that point.
So people do get surprised when they come to you and say, oh, my credit karma score is like 720 or 750 or whatever. And then when you actually pull a score, it's completely different from what they had imagined it to be?
Oh, absolutely. 80 to 85% of times, this is what happens. Credit karma is not even close. It's not even close.
Right, because it's so popular and people think that that gives them a real picture. And a lot of clients are actually telling me, why do you even need to pull my credit? Because I have it right here. Why can't you just use what I give you? And I try to educate them. I try to tell them, no, this is not how it's going to work. So I'm glad you clarified that.
Yeah, no, this is a big one because, I mean, sometimes, again, they're just basing off of your activity. Maybe they get data, like sometimes your credit card companies give you a score. And that's just based off of your activity of how you're using that credit card. But when you're doing a mortgage and you're borrowing $600,000, $700,000, there's a different ball game with the way the credit bureaus, take you as a person paying their loans. It's a different level of risk. So yeah, I always recommend it. Start your process early. Get with your trusted realtor. Get with the trusted lender. And this business is about trust.
True.
So get with the trusted lender who's knowledgeable. Get your pre-approval ready. Get your soft check done. It's not gonna hurt your score at all. You're not somebody who's applying 10 different things, so I would really not be worried about the scores changing or anything like that. And just do it the right way. This is your biggest investment.
And I also think pre-approval is very important when we are putting an offer.
Exactly.
Because it shows the seller that, okay, this guy is, he's confident, he has the money, he will be able to get a loan. And that kind of makes the seller a little more secure, knowing if he's going to accept this offer, this guy has done his work, there is a lender who's standing behind him, who's going to be willing to give him the loan, because at the end of the day, if you close or not is all that matters. So you have to be able to secure a loan to be able to buy a house.
Exactly. And if you notice, I'm sure you're very experienced yourself, but a lot of these offers are going without contingencies, and that comes to my desk or comes to me that, hey, am I okay waiving financing contingency? Which means that the client, if the loan doesn't go through, they may lose their earnest money deposit, which is a big risk to a client. I would never put my client at risk. So definitely we need to do the legwork early enough for us to be able to make an informed decision when we're putting an offer, if you have to waive financing or whatever we need to do a rush closing, right? If there's multiple offers, there's rush closings. We're conforming to the sellers. Most times I'm calling the seller's agent or they're calling me. And everything falls on the loan, because if the loan falls through, the whole deal falls through. So for me to give the confidence that, yes, I can close in 15 days, I need to have the legwork done.
And I do tell my clients, whenever we talk about contingencies, when it's about financing contingency and there is a reason or chance that we have to waive it, I always tell them, let's go talk to Rhea first, because I work with you all the time. I always tell them, let's go talk to Rhea first.
Yes.
If she says we'll waive it, we'll waive it. If not, we're keeping it. Because you do want to make sure you're not in breach of contract. You want to make sure your earnest money deposit is secure and you're not in any kind of default.
Exactly. And we are actually protecting our client. We're doing all of this for our client.
Right.
So tomorrow his funds are not at risk and we're not just signing off anything and risking a 25,000 earnest money that they're putting in of their hard-earned income.
True.
So yeah.
So we just talked about credit. Now, a question that I want to know is, what if when you do a soft pull, the score is not what they expected, or there's something unexpected on the report, or the score is not up to par with what you would like to see? How can you help with that?
Yeah, so very good question, actually. So, we have so basically I have the ability to review their credit and see if we can get some uptick on their credit scores. So we have a tie-up with the credit agencies, with Equifax, Experian, TransUnion. These are the three bureaus. And in case their scores are kind of short and maybe 20 points up will give them the best rates or a higher approval. then I can go back and run an analysis with the credit bureaus and see, okay, what do we need to do to get 20 points or 30 points? And then I run the analysis and then I share with the clients that, hey, maybe if you paid off this credit card, or maybe if you brought down a balance on something, or maybe sometimes they don't have enough credit. Like they're just not using enough credit. Then we can have a game plan. Like, okay, in the next 3 months, just get maybe 1 or 2, good credit cards, use them, pay it off, use them, pay it off. Because a lot of people I see, they just, they have credit cards, they're not using them. Or they'll just use one card, put everything on one card. Well, you need at least 3 good trade lines that you want to use effectively every month for you to build your scores. So at least 3 credit cards or something that you're using, paying off, using, paying off. Don't max out, obviously. You want to be 50% under the limit. And, so this is the type of guidance that I would give, that, hey, let's plan this. So that way we have these scores. And the rescore process that we do with Ameris, it's 3 to 5 days we can get the rescore done. So if they came to me with the pre-approval request early, and while we're pre-approving, we can even get their scores rescored in 3 to 5 days, get their pre-approval going, and it's all going in a timely fashion, and the scores are upgraded or increased at that point.
We've talked about credit scores, we've talked about credit karma, or why not to use credit karma. Now, tell me, how do you decide what kind of loan to offer to your clients?
Yeah, so, when the pre-approval comes in or the application comes in, or the first time when I speak to the client after, let's say the client says, hey, I'm looking for a pre-approval. So I go through his profile and then see the best option for him. Mainly, him or her. Mainly, we look at 3 major loan options, which is kind of very common in the market. First is the conventional products, conventional loans. Second is FHA, and then third is VA loans. So majority of the financing is conventional. Conventional programs are backed by Fannie Mae, Freddie Mac, which is like 90% of the housing industry.
Yes.
Right? So that's the first step we look at is, okay, will this client qualify for a conventional loan? Because those are the best products out there. Best interest rates, best programs, lower mortgage insurance, lower fees, things like that. Those are the cream of the cream, right? Clients which are in the high credit ratings, they should just, go for conventional. And right now, Fannie Freddie have a first-time buyer program with 3% down. So you just, you just need 3% in it. Back in the day, a few years back, minimum down payment was 5%. Now it's 3%. So there's a lot of options in conventional itself, and then we can look at fixed versus ARMs and all of that options as well, which we can talk more later. But the main one is conventional. Second option is FHA. Now, if somebody does not get conventional, and if their credit scores are not up there, they're in the mid-level scores, then conventional is not a good choice, because then it really jacks up their mortgage insurance. Right. So then it becomes more expensive for the client.
True.
So then FHA is a great option for homeownership, for people to at least get in the door and get a good loan. And FHA rates are pretty good. They do have mortgage insurance, but it's a great program to get in. And then eventually, when they build up their credit, we refinance them into conventional.
Got it.
Yeah. So that's that's another second step for us. The third one is VA, which is a veteran-only program. So it's only for veterans.
Yes.
So if somebody's been in the military, and those programs are strictly for them, and then we get their certificate of eligibility, see how much eligibility they have. Depending on that, we give an approval. Now, VA loans are very, very beneficial to veterans. So typically, if it's a veteran client, we always look at VA first. Just look at what a VA loan would do for them, and then maybe look at other choices. But VA typically for veterans is the best choice.
Now, is that the time where you decide or guide your client whether she should go for a 15-year mortgage or a 30-year mortgage?
Yeah, typically, I mean, so, usually when they're doing a pre approval and we're looking at their debt to income ratio, we calculate their monthly payments. So I usually talk with them. I have a full conversation with the client. Hey, what monthly payment you're comfortable with?
Right.
Because remember, a 15-year loan will really be a higher payment.
Right.
So many a times clients are more comfortable with 30-year payments, so that way they have a lower payment. And then I also guide them that, hey, in the future, if you want to pay an extra, like you can make your own loan into a 15-year,
yes,
right?
They can always pay extra.
Yeah, so if they get a big bonus or something like that, go ahead, throw in the extra payments. And I usually tell them, okay, to make it a 15-year, maybe you should pay $1,000 extra every month, so they can self-manage that. But generally, for risk purposes, we don't out there start with 15, because sometimes that is too tight on the debt to income ratios, unless the client has just plenty surplus income and he could do 15.
Okay.
Yeah.
Well, that's good to know. All right. So you said 3% down payment, but how do you decide what's the ideal down payment for your client?
Yeah, so when the pre-approval comes in, and when I interview them, I do ask them, okay, how much funds you have in the bank and what's available, what is their comfortable amount that they want to put down, right? And then based on that, we kind of come up with a number together. Like the client will say, okay, I only want to put 50,000 towards this closing, because we have to keep in mind we also have closing costs, so they need to have funds, just not down payment plus the closing costs
right,
as well.
Course,
so
yes.
so I usually analyze and see, okay, based on this number, I think you should do a 5% down. And then I'm also gathering info on what are they comfortable with their monthly payments, right? So depending how much down payment they do, it changes their mortgage insurance, their monthly mortgage insurance.
True.
So that's another conversation I have with the client, that, okay, how much are you comfortable with the monthly? If you do less down, mortgage insurance goes up, So
on that note, is there a scenario where, let's say, somebody has 20 or 25 or 30% down payment lying around? Can they be, in some scenarios, better off putting a lesser or a lower down payment and then get into a better program? Does that happen?
Yeah, so if someone has a lot of cash lying around, like, a lot of times clients will come, I have 20% down, or so it, again, it's a fine line. If sometimes I'd recommend clients that, okay, don't put all your money down, right? Like, once you put your money in the home, it's stuck there. Like, you can't take it out.
Yes.
Unless you later on do a cash out refinance, and do a whole refi and get the money out, or you're selling the property. So you want to think that, okay, do I want to block up so much cash in that property? And if the minimum down payment is only 5%, or let's say even a happy medium is 10% in the middle,
right,
then that's a good, and they're comfortable with the 10% payment, then that's a good number that the client and me, we kind of decide together. This is something that we work together, what they are comfortable with and what, I think is best for them, So, but 10% down or 5% down, kind of keeping it lower is probably more my recommendation.
Okay.
Yeah, and mortgage, and people get worried about mortgage insurance, that, okay, that will increase my mortgage insurance.
Right.
Keep in mind, mortgage insurance is, and again, I can speak for Ameris, where I'm at. We have 5-6 different mortgage insurance companies, so we look for the best choice for the client. So if your credit score is high up there, your income is good, your mortgage insurance is very reasonable. It's very small amount, and it goes away once you reach
20%.
20%.
Yes.
So then it's gone. So sometimes it's like, okay, do you want to put all that cash, where you'd rather do 10% down, have a small mortgage insurance, and then it'll be removed anyways.
Right, and that's important to remember, that mortgage insurance is not forever. It will drop off once you hit 20% of your payment. So,
and especially in our area, we are in an appreciating market. We have clients that come to me after a year and say, hey, Rhea, you think I can remove my mortgage insurance? And then I put them in touch with the concerned team. We look at the analysis of the market. If the home has appraised and it's higher up there, they will remove the mortgage insurance.
So at that point, is a reappraisal needed, or you just do it at your end, or do you actually get it appraised by an appraiser who's going to go to the home just like the first time, do an appraisal and come to the value?
Yeah, so that depends. It actually goes outside of my zone. It goes to the servicing team, and
Okay.
there's a concerned team. I put the client in touch with them. So they kind of, I think, follow the protocol of maybe getting the online valuation, and if that works and there's enough equity, they may take that. Sometimes they may do just an update of the appraisal.
Okay.
So it's just a process to follow to remove PMI.
But then it is possible to remove
Yes, yes,
PMI.
yes.
So people don't have to think that they're going to be stuck forever
with
with
it.
this mortgage
Plus the price,
insurance.
plus it's very competitive.
It
Like
is.
it's, again, I've been with other lenders before where we didn't have much PMI options, and a lot of the online sites where they give you the estimated PMI, those are flawed. Like they don't give right information.
Yes.
They'll put PMI at $300, $400 a month. That's not even the case.
I would like to discuss that in another podcast, because
Yeah.
that is something I also face a lot. People come to me and say, but online I'm getting this. And I'm like, no, that's not true. That's not all, but a lot of them are like bait and switch. Once you go
Exactly.
there, they'll show you a completely different picture, and then that's not really what you want.
Exactly. Yeah.
So down payment, let's talk a little bit more about that. People have to have money for down payment, and then they need money for closing costs. So what are the acceptable funds that you will accept? Is that all the money has to come from their pocket, from their salary, from their savings? Can family give them some money? What all is acceptable?
Okay. Yeah. So typically we first start, again, this all happens even at pre-approval stage. So first we'll look at their current checking, savings. What do they have, right?
Right.
So it starts with that. If they're short of funding, then I usually go over with them that, okay, what is really ideal that you can do. So one, and I'll go through a couple choices. One very, very good option and very popular is a 401k loan.
Okay.
So a lot of the clients, if they have good money and funding in 401k, they can borrow against their 401k. You just have to show them that you're purchasing a home and show the contract. And usually the 401k companies, they issue a loan, in 3 days. So that's a very, very popular source of
Right.
getting funds.
Okay.
And so and a lot of clients don't even know about it. So I usually guide them that, hey, call your 401k company, see how much you can get based on how much money you have in there. They'll tell you this is how much you can get. 3 days you'll have the money in your account, and you just have to show your home purchase contract.
Right. The first 401k is not the first thing that comes to your mind when you're looking for money for your down payment.
Yeah.
Is there anything else that you will accept?
Yeah. So besides the 401k, the next thing is they can get a gift from family.
Okay.
Now it should be only family, blood relatives. Gifts are totally acceptable. There is no limit to a gift. The client can put his entire down payment as a gift. I have lots of clients where the parents are giving a gift. And it's a very easy process. We just get a gift letter signed from whoever the donor
Right,
is,
yeah.
and then on the day of closing, they just wire the funds. So we're not even asking for the donor to give their bank statements or any of their private data. It's just they sign a gift letter saying, okay, I'm gifting my daughter or son or brother or sister. I'm giving this much, and then before closing, they just have to wire the funding.
So if the family is overseas, or if the buyer himself or herself has an account that's outside of US, can they use those funds, like from an overseas family or from their own accounts overseas? Can they use those?
Absolutely, yeah, we've done it a lot. So yeah, I mean, parents from overseas are sending gifts,
Yeah.
and again, we'll just have to show the transfer of the currency, like how much are you sending, and the currency exchange. We never ask for the donor for their bank statement, which is a great
Okay.
thing that we do. So we usually just have the parents who are overseas, or whichever family members overseas have them sign the gift letter, and they get the money to us on the day of closing, and we just show the transaction. So from that currency to this, we just need to make sure that there's enough coming in.
Okay. I have something interesting to ask. I had a client some time ago who actually was running short on funds for closing. He had a lot of gold at home. Can somebody use their own gold or any precious metal or something like that they have at home and then use that to sell it and fund that money, or is that okay with the bank?
Yeah. So gold is acceptable. Now, gold directly is not acceptable. It's not like you can get a little receipt and say, okay, this much value of gold I have and let's use this. They actually have to do a sale of gold.
Okay.
Like I've had clients where they've sold the gold, shown us the bill of sale, that this is the funds that came from the gold, and then we are using that as down payment funding.
Okay.
Yeah, so they have to actually show that. But if they have cash, if they just have cash
Right.
in the house,
Yes.
like just sitting
Hidden
in
under
the
mattress or
yeah,
something.
yes, exactly, or like a safe. Cash is not an acceptable source at all. Any cash deposits, you go and let's say you're buying a house, you put cash in your bank, and you say, okay, now let me use this money for
Right.
down payment. Underwriting will back out that deposit. We will not use it.
So they have to have a good source of those funds to show that that's how they got
Exactly.
it.
So it either has to be like an actual from your paycheck or employer or your savings.
Right.
It either has to be a gift of portion, like it has to be through a gift, either through a 401k loan, or they're taking something from their own investments, or they're taking investments from India or any other country, acceptable funds from overseas if they have their own accounts. We'll just look at their statements and see that okay, they have their monies outside. Yeah. We'll use it. We'll do the currency exchange, and we'll use it. So we pretty much accept a lot of the stuff that's even from overseas, and But yeah, anything to do with cash, that's not allowed.
Okay.
Yeah.
So one thing that comes to mind is when do you need these funds? Do you need them at closing? Do you need them when the buyer is filling the application? Like for a regular retail sale, the closing may be in 30 days or sometimes
Right.
even in 2 weeks. But let's say for a builder, you may write a contract today and the closing is in 6 weeks or 6 months or something. So when do you want to see those funds in the account?
Yeah, so typically at pre-approval, we just kind of get the data that, what is their plan for the funds,
Okay.
right? Like, if they have the money in the account or they have monies in overseas or wherever they are, we'll just ask for bank statements just to make sure they have the funds, right?
Yeah.
But they actually need to come up with the money before closing, right? So, if they're obtaining a gift, then we'll put a note in the file that there's a gift that's coming and this is the dollar amount. Gift is coming from parent, from sibling or whatever, this is the amount.
Okay.
Or if there's a loan from 401k, again, we put a note in the account, 401k, this is the asset amount, they are getting a loan. So we can prep early. We will pre-approve based on what is the plan and if it's acceptable, and then all the monies has to be before closing.
Okay,
Yeah.
got it. That's good to know. We've talked about the pre-approval process, we've talked about credit, we've talked about types of loan, what kind of funding is needed. Walk us through the do's and don'ts that people need to keep in mind when they do all this loan process with you.
Okay, so once they start the process and they're in contract, now we have a closing date, right? Yeah. So we have to do whatever it takes to finish up in the closing date. And keep in mind, there's a whole team working behind the scenes to make this whole loan process happen. It may seem like seamless, but there's a lot of work involved in the background that we have to deliver our, loan approval in time and things like that. So usually, we start with, okay, the clients need to be very proactive and prompt in any requests that are needed, because I may have their documents from few months ago when I did the pre-approval. So I need updated stuff. So we want, usually in 24, 48 hours, we want good proactive, input from the client to bring everything quickly to us, right? And then another big one that usually I tell my clients is, hey, just make sure your all bills are on time, your debts are all paid on time, maybe pay more than the minimum. Try to be, if you know you're pre-approved, try to get that debt reduced a little bit. So when we are actually in contract, we don't have more of a problem. We're looking more positive.
True.
Right?
Right.
So that's another thing that I always tell my clients. Another thing is, while we are in process, which is a big red flag, and this is something that I really out loud tell all the clients, is please be very careful in opening anything new as far as debt is concerned,
Okay.
while we are in process. Like, even if you, let's say, you're buying a house and you get a 0% deal on a furniture account. If you go there and apply for the furniture card or whatever, we get a flag. Our underwriting gets a flag that this person is got inquired for a new debt.
So we're not talking about actually buying. We're talking about applying and opening an account itself.
Exactly.
They've not actually purchased anything. They've just opened an account.
Exactly.
Oh, wow.
They
Go
will.
on.
We will get a flag that this person had an inquiry and for a furniture account, and now we have to go back and investigate what did they borrow, and so there's a whole lineup of conditions just because of that. Then we have to prove to the underwriting that no, they didn't open any debt, they just got the card. So it just adds more, chaos in the process. Especially these loans are all quick closings nowadays.
Yeah,
So sometimes we don't have time and we have to get all this. So just stay put, don't want to touch anything. In fact, that reminds me, we had a client situation like this, right?
Yes.
Yeah, which was 1 week, I would like to share that story. 1 week before closing, the client goes and leases a new luxury car.
Yes.
Without letting us know. And he just did it innocently. I mean, he didn't think that it would matter. And, well, it did,
But tell them what he actually ended up having to do later on.
Yeah, so just, long story short, he had this inquiry from the dealership.
Yeah.
Which flagged that
Yes.
he's gone and had an inquiry from so-and-so dealership.
Yes.
So the underwriting asked, hey, why is there an inquiry? And he had to explain. And then he had to explain he signed up for a lease, a new lease.
Yeah.
Then we had to get the paperwork for the lease. Well, that lease payment was $700. Now I added that in the debt ratio.
Right.
Now we have a problem.
Yeah.
We are 4 days from closing, and we now are higher on the debt ratio, and we have a problem.
Yeah.
So, unfortunately, we had to make that client go back to the dealership, return the car. That's the only way he would have got the loan.
Yes.
Otherwise, he was risking his $20,000 earnest money deposit if he didn't close in 4 days. So he went the next day. He had to return the car, pay whatever fees, and it just was so chaotic, and it was just unfortunate for him. It was just very stressful for us. So just stay put. You have a loan process in 2 to 3 weeks.
Right.
Just keep debt on the low side. Just don't open anything new. Once you're closed, obviously you're good.
Yeah.
So just have to be very mindful of that.
So the don'ts are equally important in this.
Oh,
to keep
I
in
think
mind.
they're more important. Do's, I think people know what they need to do, submit
Yeah.
their paperwork. And at pre-approval, we set the bar straight.
Right.
We tell them what they need to do already.
Yeah.
But the don'ts, these are some things that clients just do innocently.
They don't think
It's
about
not
it.
even there purposely.
Yeah.
They're just very innocent about it. They think that maybe we won't know, or, they're fine now. They've got their initial approval. They're good. But no, you definitely want to be careful.
Rhea Rai, thank you so much for your time today and coming here and sharing this valuable knowledge with our audience. I thank you very much. Guys, if you have any questions in your mind that you want answered, please reach out to us. She's one of the few people who has a lot more than 1, 2, or 3 podcasts in her. She'll be back here again, and we will be discussing more topics with you guys. If you have any questions, just reach out to us. We'll make sure we get them answered in the next video. And then thank you so much for your time.
Thank you so much. Thank you for having me. It's been a pleasure.
Thank you, Rhea.